Hello and welcome everyone to the Landmark quarterly and annual update. This is for 2025. This is as of January 15th. And I'm going to share my screen and hop right into our presentation for the day. So let me get going on that and we will start now. So once again, this is we do this every quarter, and then we also do an annual update as well too. So we're looking back really at the last quarter, 3 months of 2024, and then really kind of doing some forecasting into 2025 and looking at the residential multifamily market here in the U.S. and also immediately in Bellingham and Whatcom County. So let's hop right into that. Again, Happy New Year, and thank you for joining us. Thank you to those clients that are on the call, and welcome to anyone else who's joining us today who might not be a client at this time. We're going to, again, go through the 2024 recap, look at 2025 and beyond, and we'll make some predictions and hopefully give you a lot of information and a lot of data. Okay, so today we're going to review the national multifamily market. We're going to look again at the local Bellingham and Whatcom County market. And then I'm going to give you several different issues impacting the local and national real estate market moving forward. Positive, negative, and neutral. So before we get into that, I am Troy Moliat, owner of Landmark Real Estate Management, and we at Landmark have a purpose and a vision. That is for you, for those of you that are our clients. We steward your properties and we help you build wealth. And we're excited about doing that. We do that each and every day through property management. And so for those of you joining us for the first time, welcome. At Landmark, we also have some core values. We do what's right. We do the right thing. We solve a lot of problems. We are problem solvers. We maintain accountability. We drive change. And then we love to serve others first through everything that we do. So just wanted to share that with you a little bit. Again, thank you again for joining us here. Here is the executive summary of the multifamily market for the nation. So this is the U.S. multifamily market. A lot of the data I'm giving you is coming from CoStar. And again, a lot of the data that I'm providing you is multifamily apartments, 5 units and up. So in a lot of our surveys, we don't have a lot of data for single family homes, duplexes, triplexes, and fourplexes. The service that we subscribe to mainly gives us data for 5 units and up. So I just wanted you to make sure that you keep that so you understand where we're at and the data that we're giving you. Here is the summary of that, and let's hop right in and go through that. I believe in 2025, that really it's the time to start looking at buying. I think sales have been down, and I think that we're going to see some unique buying opportunities. There's some headwinds, though, there's no doubt, but I do believe that 2025 is the time to start looking to buy if you are an investor of apartments and multifamily. There could potentially, with new government coming in play here within a week, that you could see some tax breaks for real estate. Again, not political one side or the other, but you could see some unique tax breaks that could really benefit people wanting to invest in real estate. Additional bonus depreciation, a variety of different reasons. So again, I think that that combo could really start fueling some of the real estate market. Construction is really at historic highs, and it peaked back in 2023, and it's been falling off ever since. But we've got a lot of new construction in the market still nationwide. Vacancy rates are at 10-year highs due to all that construction, and they really peaked this past quarter in 2024. Existing rents are flat, and really slightly increasing to stable. I think in 2025, we're going to see rents be stable and then start to push up a bit moving beyond. And so, again, I think 2025, unique opportunity, a lot of stabilization, and could be the time to start looking to invest more. Sales have decreased 65% really in the last 24 months. However, in the last quarter, we've seen them uptick a bit. So sales are starting to come back of apartment buildings and units, and you'll see that in some of our data. Interest rates, man, I've been saying that we think that they're going to be lower. They keep going up. The 10-year is right around 4.7 today, 4.7%. Who knows where they're going? Could be that we see a couple of decreases in the prime rate and the Fed funds rate this year. But again, the market determines where interest rates are going to go, and they're still peaking due to some inflationary causes. Cap rates appear to have topped as well too, and so I think they've been coming back up, and now they're going to start to flatten out and then potentially come back down. And then the price per unit, when we look at that, what people are paying for an apartment building has been falling really since the peak of the second quarter of 2022. And so we're starting to stabilize, and you're going to see that I think that's going to start shooting back up again. So again, all the reasons why I believe 2025 is the time to start buying. Okay, let's look at the local market now. This is for Bellingham and Whatcom County. New construction has driven up vacancy rates really over to 10-year highs. And we're starting to soften a bit, but we've been talking about this for now about 18 months. And we've been predicting that vacancy rates have been going to increase, and they have increased, and they're starting to come down a bit now. New construction for 2025 and 2026 is anticipated to slow. We had a huge boom of construction. That inventory locally and nationwide has really been working its way out into the system, really drove up the vacancy rates due to all the new apartment construction, multifamily construction we've seen back in 2021, 2022, 2023. It's harder to pencil a deal today. So because of interest rates, and costs are high. And so that is also fueling the fact that we're not seeing a lot of new projects coming online. So again, that's positive if you own investment real estate or looking to buy. Vacancy rates have peaked really this last quarter. Could be a little bit of volatility in the first part of this year with a couple of new properties coming online. We'll see how those absorb, but we do believe that they have peaked. The overall rent per square foot fell slightly in the second and third quarter of 2024, but it's been stabilizing and starting to move back up. And so that's again positive for rents, for owners and investors of multifamily. The sales of multifamily properties are flat due to interest rates and buying power. Cap rates have been rising slightly and again topped out both nationwide and locally here, we believe. And that we do believe that the local market will outperform the national market. And so we're continue to be bullish on that. Lastly, there are some potential new regulations at the state and the local level. We'll get into that a little bit later. And that, again, could impact a few things on the real estate side. We'll see how those play out, but we're really involved and active in that on your behalf here at Landmark. So let's hop in and dive deeper now. That's our executive summary for the national and the local market. Let's dive now into some of the details of the U.S. Multifamily market. So again, CoStar data, 5 units and up, nationwide. What's the vacancy rate? What is the vacancy rate currently out there? Well, back in January of 2023, a couple of years ago, we were at 6.3% in the US. We started shooting up every quarter. We were moving up, moving up, moving up. We hit 7.6% in January of 2024, a year ago. And then on our last webinar, a quarter ago, we were at 7.9%. So starting to slow down, but still increasing. And then as of today, we're at 8%. So we're starting to top out, and we believe we've hit the top in the nation at 8%. Here is a graph that shows you that, and you can kind of see, and again, we talk about overall vacancy versus stabilized vacancy. So the numbers I'm giving you here are overall vacancy. This is the yellow line there is the overall vacancy, which takes into account all units that are currently under construction. So brand new units are in that mix. When we take those brand new units out that are in lease up, we get the stabilized vacancy, and that number is lower. So if you own a building, you're not in a lease up, it's an older building, you should be somewhere around 6.2% in the US. So again, overall vacancy versus stabilized vacancy. This is when we're looking at the US overall, we look at how many units we've delivered in the last 12 months. And that number has been dropping. That's the green arrow showing down. It's coming down. And so quarter over quarter, we've been dropping. We still delivered 663,000 units in the last 12 months. And then how many units do we absorb? And so again, when we look at those two numbers combined, because we're not leasing up or absorbing more units than we've delivered, vacancy goes up. And so that's why the vacancy has continued to increase. So construction's coming down, delivering less units, still absorbing. That will then make the vacancy rate fall. But we haven't seen that yet. We think we're there in the US. We think it's going to start to fall. Here is the average rent per square foot. We take every single unit, studios, ones, twos, threes, fours, eight, but you name it, we take them all and we look at them all and we can see kind of what the rent per square foot is over the past several years. And you can see that we peaked right around $1.95 back in the mid part of 2024. And we've been kind of in this range really since 2022 to 2024, between $1.90 and $1.95 a square foot. We had a huge increase right after COVID in 2020 through 2021, large increase from that $1.65 up to $1.90, large increase. And this is the long-term trend line. So we're slightly below the overall trend, and we're starting to see that curve up a little bit as vacancies start to soften and we start to absorb more product, and we'll start to see that move back up. This is market data that will show you multiple years on the rent per square foot. And here's one of the reasons that I believe now is the time to buy, and I'm definitely bullish on the market. As you'll see here, right now, we're at about $1.93 a square foot. That's where we're at today. And as you can see, when we start to look at the next few years, we're going to start to approach by really probably by year end in 2025 over $2 a square foot. And then we're moving all the way up to 2029 to where we're going to be somewhere around 230 a square foot. So again, looking at those trends, this is overall rents, where are they going to be? And we can see that vacancy is projected to fall and rents are projected to start to move up. That's about a 15% increase over that 5-year time period. So again, steady, probably more normal with the long-term trend. And again, just wanted to provide you with some of that more concrete data to show you why we're bullish. Here are the deliveries. These are all the orange bars are how many properties were delivered by quarter. And so you can see that we peaked back in 2024. That spring of 2024 was when we delivered all of those units. And we've been falling off really since. And so fewer and fewer units are getting built. Interest rates, construction costs, a lot of markets with a lot of heavy vacancy right now. So again, the market cycle is in a pullback area, and we've overbuilt, and that's good for the tenants. And now it's going to start to work itself out into the system, and we'll start to see rents normalize and move back. Here is when you look at all the different markets that have more than 50,000 units or more in their inventory. And we look at where the highest vacancies are. And you can see right here that we've got a lot of units here. This is where vacancy is right here. You can see Austin, 15%, over 15% vacancy. San Antonio, Colorado Springs, everyone on this list basically has a 10% vacancy or higher. in the United States. So again, vacancy, we've been overbuilding in a lot of these markets. This is some other data. Again, we look at like Durham, North Carolina. Over 11% of the total inventory in that market is under construction today. So again, a couple of these markets in North Carolina where they're just continuing to overbuild right now. So a lot of inventory, and you can see the rent growth has been coming down and vacancy has been increasing. So again, if you're looking at a different market, you want some info, feel free to reach out to us. We have all the data in the entire US. This is a different data provider, Apartment List, that I also look at. They have a different sample size, which does include some duplexes, triplexes, and fourplexes. Not all of these are 5 units and up. And their overall rent per square foot in their survey is a little less, but the graphs and the charts look very similar to CoStar's data. And so I like to present this data as well. And this just shows you kind of where that median rent is. Median rent just under $1,400 in December of this past year. And you can see that really since 2022 through currently, the current date, really for about a 3-year period, we have been sideways to actually trending down slightly. This kind of explains the COVID explosion. A lot of dollars in the system. People were renting apartments left and right, and we saw rents just skyrocket in the U.S. And so this is year over year increases. And right around January of 2022 is when we peaked, where we had over 15% year over year growth in rent growth, really unsustainable rent growth. And that chart has come way back down in 2023, and it's actually negative for almost all of 2024. So rents have actually been pulled back. And as of December, rents pulled back about 0.6%, just under 1%, according to apartmentlist.com. Here is kind of the monthly change as we look at it. And so again, you're either above the bar, the zero line, or below the zero line. And you could just see, and you can see back in 2021, craziness going on where we had a lot of rents increasing at dramatic rates month over month. Currently, really for the past several months, we have been negative. Here is apartment rents as compared to CPI. This is not updated with the most current CPI. I'm going to have that later in the presentation, but the chart's pretty well the same. And you can just kind of see where rent really was a big part of that factor in adding to CPI. And now it's come way back down, and that's helping bring the overall CPI back down to closer to more normal levels. Still way out of control. We've seen a lot of costs of goods sold increasing, and this graph really shows that as compared to top line CPI, CPI of residential units, and then really the apartment list index. Here is the vacancy rate. Their vacancy rate's a little bit lower than CoStar's. It's just under 7%. But again, the graph is very similar to what we've seen on large apartment buildings to smaller units as well. Here is an interesting stat that they provided. And because of all the inventory that we're seeing in the markets, what's happening is it's just taking longer to rent units. And so the average list to lease time, according to this survey, was 36 days. That's a record for really 6 years. That's kind of an interesting trend that we're seeing. And so that market, during the peak back in 2021, obviously it was under 20 days on average to rent a unit. We're almost double that right now. Okay, let's talk about some key stats. The second quarter of 2024 was the top for multifamily construction, units added. New permits and construction is anticipated to slow pretty dramatically in 2025, which will bring down the supply, allow us to absorb new units, and vacancy rates will start to come back down. Absorption is still strong and will continue to be strong. People are still renting units. They're moving, they're renting, they have choice. And due to supply, The time to lease is at really a 5 to 6 year high. Um, let's look at some sale data now. Let's talk about sales in the US. I love to show you this information. And again, these are 5 units and up, CoStar data. And you'll see here that that peak value was right around spring of 2022. And when you look at the volume of sales, we had a huge spike there back in the last quarter of 2021, record bar. And really, we have on average been somewhere just under 40 billion. And you can see now that we've been bottoming the past couple of years, mainly due to interest rates, not enough buying power. 2021, 2022, a lot of low interest rates, a lot of sales activity. And when that buying power dried up, of course, sales plummeted. And so, but they're starting to move back up in the US. We're seeing more and more sales coming in. Just got back from an investor conference in multifamily, and again, talking to brokers and investors nationwide. I think what you're seeing is a lot of the institutional buyers they stepped off to the sidelines and they're not back in. So the private buyers and the private investors are the ones driving the market right now, and they're starting to buy more and more. And then as interest rates come down, if they come back down, then you'll see the institutionals come back in, the larger equity groups. And so that's the general trend and consensus, what I'm hearing nationwide. Here is, again, just bottoming sales, but we're starting to move up. We're starting to move up on sales above that $20 billion a quarter range. And again, when you look at the blue line is really the average sales price per unit. And you can see that we have really been bottoming in 2024, and it's projected to move up and really make new highs potentially in 2027 or 2028. So again, from a value standpoint, we could be at the bottom here now. Okay, key stats. Values peaked in the spring of 2022. Values have pulled back and appear to be stabilizing and potentially moving forward. The supply of new units is slowing. Again, that construction is down. With reduced new construction, values will continue to increase and potentially set new records in 2027, most likely by 2028. And I think it's time to buy. I think now is the time to start looking and looking to buy. Granted, buying power is still tough. Interest rates are high. I get it. I realize that. But again, from a value standpoint, this is the time to probably start looking at buying in 2025. Transaction volume was really up from the fourth quarter of 2023 to the fourth quarter of 2024, and really in the last 12 months. But sales are still down almost 65% from those highs in 2022. So again, sales still down, starting to normalize, seeing more money starting to come into the market. And again, it'll be an interesting 2025 to see if these numbers start to increase and people start to buy and values start to move back up. Let's talk about cap rates. What is a cap rate? A cap rate is essentially an indicator between your net operating income. That's what you should be able to take home before you make your mortgage payment. And it's really an indicator between the NOI and your sales price or your value of your property. So another way to say it, it's your annual rate of return if you paid cash for a property. A lot of people say you want to, obviously buy stocks, buy low and sell high. With a cap rate, you want to buy high at a high cap rate and you want to sell low. So it's inverse. Again, I know that's a little tough, but think of your rate of return if you want to buy it. You want to get a high rate of return, buy at a higher cap rate, and you want to sell to somebody else during a time when they're expecting a lower rate of return or a lower cap rate. So again, inverse correlation there. But again, hopefully that's helpful. This will help kind of explain where cap rates have been. And when you look back into 2021 and 2022, you really see in that spring of 2022, you see that the US market, the 4 and the 5 star, the highest quality assets were selling at cap rates below 4.5%. Very, very aggressive. Really had never seen those low cap rates in about a 30-year history of multifamily. So record lows back in 2021 and 2022. And then, when you look today where we're going and where we're at, we're somewhere right now between a 5.5 cap and about a 6.2 cap, depending on the quality and the location of the assets in the U.S. And so those have been moving up, and you can see that projected in 2025 and 2026 is for those cap rates to start coming back down. That's good for you that own investment real estate. So let's talk about the summary. This is the nationwide multifamily summary. The construction boom has peaked. It peaked this past spring, past couple of years, and that's really pushed vacancy rates up. Rents are flat to slightly increasing with new product. As the new product comes online, that higher quality product, it does bring that average rent per square foot up slightly. But again, rents have effectively been flat to even decreasing in some markets. Vacancy rates are rising and we believe have peaked in the US at right around 8%. Sales are increasing, which is good to see. And then really loan to values, if you're looking to buy, your buying power is dried up because you used to be able to get 70 to 80% loan to value on a multifamily apartment transaction back in that 3 to 3.5% interest rate. Today, you're really between 50 and 65% down, or 65% loan to value, but because rates are 6.5 to 7.5%, so that's kind of where we're at today. Cap rates have really started to top out, as we saw in that last graph. And they're very interest rate driven. There's no doubt that there's a direct correlation to interest rates and cap rates. More buying power I have, obviously the cheaper that interest rate tends to be. The price per unit has been falling since the peak of second quarter of 2022 and appears to have stabilized, and it looks like it's going to be moving up for the next several years. So that's what we're seeing in the market, and that's what we're anticipating. Okay, let's hop into the local Bellingham market. We are on track. It's about the bottom of the hour here. And we're going to look at Bellingham and Whatcom County. So what's the vacancy rate currently? Let's look at that. Look at our market. And again, this is a survey based on 5 units and up. It's not all the product in Bellingham and Whatcom County. No single family homes, no duplexes, triplexes, and fourplexes in this survey. So just want to make sure that's clear. Back in January 2023, 2 years ago, 2.4%. We were started to really shoot up in 2024, and we were a year ago at 6.6%. We peaked actually last year right around 8%. And so you're not seeing that on this chart, but we were continued to move up. And then by this fall, we came back down to 6.3%. And today we're just above 6%, 6.1%. So healthier. Here's the graph that kind of shows that market and how that's happening. Again, we're looking at the overall vacancy and the stabilized vacancy. So that overall vacancy peaked at just over 8% back last year. Those units got absorbed, and then the vacancy came back down. We're projecting that vacancy is going to pop up a little bit due to some deliveries coming this first quarter of this year. And then that stabilized vacancy is right around 4.8%. Could pop up to about 5% this year and then start to fall off. We'll see how that plays out. But again, right between 4.5% and 5% is that stabilized vacancy number. When we look at the amount of units delivered in this market, again, we did this for the US. Here it is on a micro scale for the greater Bellingham market. We delivered about 750 units. That's up a little bit from the previous report. But we've been absorbing a fair amount, 717 units, and the vacancy rate actually fell a little bit. We had absorbed a little bit more the past quarter than we had originally anticipated in the survey. So the vacancy rate actually fell slightly. And then we're seeing that rent growth, the asking rent growth, just moderately up at 1.1%. It's up, it was under 1% last quarter, so it is up slightly. Here, when you look at the breakdown of the vacancy rates between the product types, you can see that 4 and 5 stars actually have the lowest vacancy rate. They're under 5. Whereas that 3-star property is closer to 7%. And then that 1 to 2 star property is actually the lowest vacancy at 4.8%. Here is this is a lot on this chart, and I've showed you this chart if you've followed our webinars in the past multiple times. This shows you the US vacancy, which is the yellow line. You've got the green line, which is the Bellingham vacancy. So again, we're right at or slightly below that US vacancy rate. And then you've got the deliveries. You've got how many units, the blue bars are how many units were constructed. And then the orange bars are how many were rented or absorbed. And so a lot of activity on here. And you can see that we've got one big project that's going to deliver a bunch of units. And then after that's done, the vacancy rates might pop back up a little bit, and then they'll start to come back down. So we'll know more once those units are delivered. They're in the north part of the county here, and we'll see how that goes. And then there's really not a lot being planned or to be built in after that, in later 2025 and 2026. So, and we'll show you some of that data here later. Here is the average rent per square foot. And again, when you look at that long-term trend line here, we have been ranging right around $2.15 a square foot. We fell down mid-year with a lot of that supply, those increased vacancy rates. We're still below the highs of 2024. And we're just kind of bouncing between, 215 and 217 a square foot. Let's look at some sale data in Bellingham. Again, not a lot of activity. 5 sales in the past 12 months. Average price per unit was about 182,000. Average vacancy at the sale was just under 5%, and just a little bit of data here for you. If you want more sale data, we can provide that to you. Feel free to reach out to Kim or myself. Here is the chart of the sales volume. And again, you kind of see the same lines that we looked at on the nationwide market. The green is actually the sales price per unit nationwide. And then the Bellingham, which is slightly under that, you see that blue line there. And then the orange bars are the volume. And again, 2021, 2022, a couple of big transactions in 2023 were a lot of the activity. And really today been very little activity. We actually had I think there was only one sale in the fourth quarter of 2024. Here are cap rates in Bellingham. Again, you want to buy high, sell low, and you see the U.S. Cap rate average is right above 6% there. And that's the yellow line. And then Bellingham, 3, 4, 5 stars are they're below. So we're still right around 5.5% cap. Again, not a lot of sale activity, but here's kind of what you're seeing in the market. And we've, again, very similar to the US market. A lot of markets that I look at, this is the same type of graph that we're seeing, albeit based on a lot of limited data. So there's the US caps, and then we've got those Bellingham cap rates down there below. Okay, we're going to bring Kim back. Kim, welcome back.
Thank
A
you.
lot of information there for our webinar viewers. You're going to talk to us about some landmark data. So
Yeah,
how does
excited.
landmark rate as compared to
Yeah,
the
how do
US?
we How do we compare? Well, let's take a look. So, as you may remember, a couple slides ago, Troy just shared what the Bellingham vacancy rate was, and that was for 5 and more units, 6.1%. But here within Landmark, with our portfolio, we're at 2.3%. So we're doing well. Last quarter, we were at 3.8%.
Mm.
And so that number does include our new construction. So properties that are in lease up mode. So we're doing better than last quarter, above and below average vacancy rates. When we look at taking out new construction, taking out the properties that are in lease up, we're at 1.8% vacancy, which we feel very good about. And last quarter, we were at 2.5. So, I think those are really strong numbers, especially for winter season. Now, granted, most of our units do turn in more the summer to springtime, but we do tend to see units sitting a little bit longer that are coming online in the winter months. So, to look at the quarter four average vacancy, we had a 3.2% for the quarter four of 2024. And the quarter before that, we were at 3.6. So we are seeing a downward trend in Landmark's portfolio vacancy. My next slide I'm going to show you guys is some average price per square foot. So this is popular when we're talking to developers, people looking at what are average price per square foot. So again, this is just Landmark's data internally with a portfolio that we manage, but you're looking currently right now on average, we're getting $2.80 a square foot for studios, $2.35 for one bedrooms, and $1.99 for two bedrooms. And then you can see a kind of the lowest one is three bedrooms. The price per square foot drops to $1.72. And then we start picking back up on the 4, 5, and 6 bedrooms. But I know that that is a popular slide, and I'm happy to send this to anybody that's interested after the webinar as well. And then the next slide is another favorite, and these are our average rents per bedroom size. So we looked at the price per square foot, and then this is the average monthly rent. So studios, on average, again, we are getting less on some units. We're getting quite a bit more on some units, especially our newer construction. 1303 for a studio, 1426 for a one bedroom, 1751 for a two bedroom, 2,299 for a three bedroom, and 2,935 for a four bedroom. I also have that broken down, 5, 6, and 7 bedrooms, because we still manage actually a handful of larger homes as well. But I just wanted to include the more common average rent bedroom sizes for you guys there. I've been looking at some surveys that were completed by Zillow, surveys of tenants nationwide. According to Zillow, current apartment lease ups are taking on average about 15 months to lease up. So new construction's taking on average 15 months. And rental concessions are up 35% from last year. So as Troy's already shared, there's a bunch of new construction coming on board. We are seeing more concessions. We are seeing increase nationwide in vacancy rates, and lease ups are taking longer than they have in the past. Again, supply and demand factors there. I thought this was an interesting survey that was asked to tenants as well. So what's the number one reason why tenants are moving? And the number one reason is they're looking to seek a better unit. What is a better unit? That's subjective. But getting into some of those more details, they are looking for lower rent. Maybe their rent rates have continued to increase, that renewal time. And others are also saying they're seeking a better community. That could mean the community as in Whatcom County. It could mean the apartment community as well. But those were kind of some stats and reoccurring trends on why tenants move. Sorry, can you go back? Roughly one third of renters surveyed plan to move in the next 12 months, where nearly half intend to renew their current lease. And I would say that is a very common trend that we see here at Landmark as well. Now, granted, we do have about a third of our residential portfolio is geared towards student renters, but we do notice that turnover is roughly about a third of our portfolio each year. So of those surveyed, about 19% didn't know whether they were renewing or not. 46% plan on staying, and 35 plan on moving. Now, granted, a lot of people were surveyed. It's probably very dependent on when their lease comes due on whether they know whether they're leaving or not. But just some interesting statistics there I wanted to share. The next one's a hot topic. You've heard us talk about this quite a bit. We sent out a lot of information, emails, and copies of ordinances and where to contact your local city officials regarding the proposal of the rental restrictions and basically trying to eliminate landlords from charging unfair or excessive fees. So that is in the city of Bellingham. I'm not even sure what rendition they're on. They've had multiple meetings and feedback. And thank you so much to all of you that have written letters to get our concerns across. Troy and I have also met with city council members on one-on-one meetings. And next Wednesday, Troy and I were actually invited to a focus meeting. So there's going to be a mediator, moderator there, and we're going to have a focus group meeting. They're looking at large landlords, small landlords, and tenants. So trying to get perspectives on this new ordinance they're really trying to push forward. Some of the main points in the latest rendition they find it very important that disclosure of all costs to tenants is clearly defined in lease. And I think that all sides are in agreement of that. So disclosing what are the utilities, what are the costs associated with being a renter and having a lease in place. Some other main points of the new ordinance, they'd like to cap application fees at $50 per application. They would like to cap late fees at 2%. They would like to cap security deposits at 1 month rent. Pet deposits capped at 30% of the rent. And basically no other fees can be charged. So no admin fees, no serve notice fees. If a tenant locks themselves out, you can't charge a fee to give them a new key. So they're really trying to eliminate any unnecessary, unexpected fees. And obviously that some of these fees that they're trying to eliminate or downsize on will have a major impact on a lot of landlords. So again, Troy and I are working hard to work with legislators on this and to share your guys' feedback and stories. And so we just appreciate so much you continuing to share those and to reach out. We are working hard for you on that. More to come. How are they going to fund this new ordinance? Because it's going to take a lot of policing and following up. So the city's plan is to increase rental registration rates. So currently, if you have a rental property in the city of Bellingham between 1 and 20 units, you pay $20 per unit per year for a rental registration. They want to increase that to $30 per unit. If you have over 21 units, you're currently paying $16 a unit, and they want to increase that to $26. So they're looking to increase those fees by $10 per unit to help pay for additional resources to monitor violators of this new ordinance. So, again, more to come. We will continue to keep you updated. I know we have a lot of people on this webinar that aren't currently Landmark clients, so I just wanted to share my contact information. That's my direct email, my direct cell phone as well. We are more than happy to do a free market analysis for you of your rental property, let you know what we think the market rent is. Just share some feedback and ideas and how we can help you build wealth and optimize your ROI. So we love doing that. We're passionate about that. That's what we do. And so feel free to reach out. It's free. So here to help. And I think that was all that I have until we get to the end. I'll give you some more Landmark client updates, but that is the Landmark stats.
Great. Thanks, Kim. Appreciate it. That's some
Yeah.
great info. A lot of moving targets. We're very involved, as you said, and doing our part to make sure that the landlord's voice is heard, and that there's some compromise and some reasonableness when it comes to some of these new rules and regulations. So, thanks, Kim. Appreciate it. We'll see you here at the end for Q&A. Um, okay, well, let's hop back into our webinar here. We got about 10, 15 minutes more, and then we'll be done and have some Q&A time for you. I always bring up some factors that are affecting real estate moving forward. And I feel like a broken record because I've been talking about this for 2 years. Interest rates, they continue to be one of the largest factor, if not the largest factor. And when we look at interest rates, I tend to look at the 10-year Treasury chart. This is the one that trades in the market based on bonds. And so right now, we are, again, when you look back to the 80s, this is where the 10-year Treasury was, over 15%. We have really been on a long-term trend here down. And we've been kind of bumping up and coming close to 5% again. Even with the Fed reducing rates last year, the 10-year Treasury is still higher. And so the market is not agreeing with the Fed decreases. And therefore, we're trading right this morning. As of today, we were just below 4.7%. CPI report came out, and actually the Treasury rate was a little lower. And so it's softening a bit, but we've been bouncing between 4.5% and 5%. We dipped under 4% there for a while. We thought maybe there was some that would start to move back down even lower into the mid threes, but here we are back up mid fours. 5% seems to be kind of a ceiling right now, and so that's kind of my target, is that we probably will not budge too far above 5%. And then for investors, coming down below that is really what they're looking for. Here is the basically the 40-year downtrend, and that was broken back at the end of 2021. 2022 really broke that long trend line of rates, that 10-year Treasury. And so, and that's contributed to cap rates also coming down over the last several decades as well, because borrowing power was stronger, cheaper, and so I could borrow more at a lower number, and so that the music is over on lower interest rates for now. Here are mortgage rates, 30-year mortgage rates. Again, a very similar type of chart to the 10-year Treasury. And mortgage rates also contribute to that. I just put this into the presentation. These numbers came out this morning on the 15th of January, the new CPI numbers. And so again, you see all items at 2.9% versus when you take out food and energy, we're at 3.2. That number was a little bit lower than everybody anticipated. Hence, stock market's up and the bond market is up, which then drives rates down. There's an inverse correlation to when people buy bonds and the interest rate that they get. That basically creates the Treasury interest rate. So overall, still positive news, no major surprises, and could be healthy for, again, CPI in general coming back down and normalizing. When you look at CPI, everybody's talking about it. I threw this in. When you look over 10 years at a McDonald's, Happy Meal or a burger, I mean, they're up over 100%. That quarter pounder with cheese with the Coke is up 122% in 10 years. So I don't need to tell probably everyone on the call that inflation is up. And this is just kind of a fun little graphic that shows that. Um, Here is a also kind of a correlation to what we say the average cap rate versus the average 10-year treasury rate. And we look at the difference between the two. And so when that's wide, there's a lot of opportunity for good margin. When it's narrowed or even inverse, it's there's not a lot of chance to find margin. And so that margin is about as tight as it's been in a long time, around 240 basis points. And that just means that there's just not a lot of, there's just no leverage. There's no positive leverage between what the rates are and where cap rates are. So again, and when you look here at the overall mortgage rate, so the 10-year treasury isn't your actual interest rate. You have a margin on top of that. And really back in 2022, we had the average interest rate well above the average cap rate, which that is the main reason right there. When we broke through that number back in the first quarter of 2022, that really put the kibosh on sale activity. Negative leverage. I have to then put more money down to then get a return on my investment because my interest rate is higher than my cap rate, what the property is generating. So cap rates have come up a bit and mortgage rates. Let's talk about the second factor. That's new inventory. Here is a snapshot from the city of Bellingham. And when we look at how many units have been final in this past 6 months, it's down. We're coming down. We're not building as much in the city anymore. 302 units versus 389, and that number was even higher the last several quarters. So it's been coming down steadily for about a year and a half. Under construction, we are up a little bit because we do have a couple of projects that are newer that are under construction. And so that's up from 356. And then when we look at units in application, that is down to 602. So when you look at both of them, we're still overall construction and properties in application are overall still down when we look at both of those categories together. But again, this is right on the City of Bellingham Permit Center. You can go here and look at this in real time. You can click on any project and see what's happening and what's going on within the City of Bellingham. Number three, the single family market. And I show you a couple of slides. These are residential homes only, no condos. And I'm looking really at two main charts, the median sales price and inventory of those homes. And so when we look at those, you'll see here that we have the red line I throw on Seattle. And you can see that the median price in Seattle versus the green bar, which is Bellingham. And then the purple bar is Whatcom County. And really, everything came back down in late 2023 and 2024, and then we've been moving back up again. So prices have been coming back up. It's just sales are down. So when we look at how many homes for sale, inventory is coming back up. But when we look long term at how many homes are on the market, we are still very, very low. And when we go back and look at the Great Recession, which is a long time ago now, over 15 years ago, 2008 to 2011, you'll see that inventory was very, very high in all three of those markets. And then today, we're still very, very low. We're still below a lot of the historic numbers, which is, again, kept values higher because we're still not building new homes and we're just not seeing a lot of homes come on the market. Let's talk about nationwide inventory. This is an inventory list, housing inventory active in the US. So when we look at how many homes are for sale in the whole US, this is that chart. And again, still a lot higher, over 1,000,004 back in 2017. And today we're somewhere just under 1 million. And so again, but up from below 400,000 homes back in January of 2022, when all of the mayhem was happening in 2021, 2022, low interest rates, a lot of money into the system, people buying homes, second homes, third homes, investment homes. That really drove that inventory down. We've been building that back up. The gray bar on there is COVID, so you can kind of see when COVID hit, and that's highlighting that. This is another one that just shows the total amount of inventory on the market. And when you look back over a historic time period back into the 80s, again, we're well below that historic average. And then you can see in 2005, 6, 7, 8, we really built a lot of inventory. A lot of new homes came on the market, a lot of new product. And that created part of the a reason why we had too much inventory, and it created a debt crisis and then a major recession. So here is the average sales price, I'm sorry, the average sales price versus the median sales price in the US. So the blue bar is the average sales price for all homes sold, right around 500,000, versus the median price, which is was over about 430,000, but it's been falling back down to right above 400,000. So, and we had obviously some large increases there, as you can see. Those graphs back right after COVID, again, when all that money was into the system, value shot up, inventory came back down, and here it is on a graph. The green bar is essentially the S&P Case-Shiller index, and that just kind of shows you where that index is. And it's been fairly overpriced for a very long time. And so that said, here is average and median home prices in the US. Let's talk about nationwide home sales and how many homes are selling. This data comes from Redfin. And again, data is down. We don't have December data compiled and in yet. But, when we look back into November, year over year, again, new listings are down slightly, but sales are up. Homes for sale are up. So the amount of inventory is still increasing, but the number of new homes listed for sale in the month are down. This shows you the housing. This is essentially the home sales and when they happen by month. And so you can see a lot of homes selling back in 2021. And then really those sales have been falling off pretty dramatically. And again, 2025, we'll see what happens. Very interest rate driven, this chart. Housing starts. This shows you all of the housing units, the permits that have been issued for single family homes. That's the blue bar. And then the red bar is multifamily permits. It goes all the way back to the 60s here, because I think it gives you a good perspective. You can see that blue bar when we were building a lot of product in the early 2000s, mid 2000s. 2005, we peaked right around 2007 of inventory. And then what happened? The faucet shut off, permits just tanked residentially. And then we've been building back up. But again, probably back to more of a normal average right now, but we still have a gap of the amount of inventory that is there and that we need to be building. So we're still a couple of million units short to make up for those lost years back to the Great Recession. The red is multifamily permits, and we've been building multifamily. Multifamily permits have been strong. And as you can see, really in 2021, 2022, decade record high of multifamily permits we've built, and vacancies have shot up. So two different stories on this chart. Multifamily permits skyrocketing, building a lot of product. A lot of cities need infill housing. They're welcoming developers to build. That occurred. It's been falling off since. The residential market, really an entirely different story. Here's locally, when you look at the new permits that have been issued locally, and this just kind of shows you that, again, 2024 was above 2023, but we're still down. And then you can kind of see the last 6 months, we've had 302 units permits finaled. Almost 2/3 of those were multifamily over single family. Here are permits, new residential units permitted in the city since 2000. And again, you look at the large bar, 2021, same story, different graph. And a majority of those were multifamily permits. 72% of all the permits being issued, multifamily over single family. So, not a lot of multifamily permits being issued, but I'm sorry, single family permits being issued and homes being built. We're seeing a lot of multifamily being built in the greater Bellingham area. Okay, let's talk about affordability versus rental rates. Couldn't find an update. This is a little dated. It's back to kind of middle of the year in 2024, but the numbers are still very, very similar. When you look at the owner's equity of a residential, a rent for a residence versus the house price. So if we had a renter, this is the gap between renting and owning. And today, it's cheaper to rent, cheaper to rent. And so when you look at that opportunity, huge, huge gap here. And this is the really the main function of this is interest rates. This shows you buying power of interest rates for if I've got to buy a home today, what my mortgage payment's going to be. That's that blue bar, really at an all-time record high, versus the orange bar, which is the owner's rent equivalent. What can I get for that unit? So again, big delta. And that is a big part of the story. And this is healthy for you that own residential real estate, that are renting, because there's a big gap. It is cheaper to rent today. Last one. A lot of people always ask me, "Hey, we're gonna have a recession? What's gonna happen?" The story is very different than the Great Recession when you look back and you look at housing, you look at bankruptcies and foreclosures, really very, very low when we look back. When you go back to 2007, even 5, 6, 7, the numbers were much higher. Credit has tightened a lot. We're not issuing a lot of unique loans, 100% loans. I mean, banks in general on the single family side and the credit side are healthy. And so this really shows that from where bankruptcies and foreclosures are. Could this change? Possibly, but the data isn't showing that it's a very different story than the Great Recession. Okay, summary and conclusions. And we will get on to some questions. Bellingham and Whatcom County vacancy rates have remained lower than the nation average, and we project that they will continue to remain lower. New construction in our areas has pushed vacancy rates back up to normal levels, a little bit above the normal level. And vacancy rates have peaked. And so we've seen that in that quarter over quarter, we've been coming back down to that low 6% range from the high of 8 this past year. Higher interest rates will keep homeowners in their homes longer. A lot of people with 3% mortgages, they're not going to sell. That means inventory is going to remain low. And again, not that much product will come on the market. And, that is somewhat bullish for rentals. Housing payment to rent, the gap has never been higher. As we showed you on that graph just a few slides ago. Again, cheaper to rent than to own a home today, buying a home at the median price, at the average price today with today's current rates and interest rates. The long-term real estate outlook continues to be positive for Whatcom County. We remain bullish on this market. And I think you'll see fewer multifamily sales again, even though they're picking up a little bit. But interest rates are the big story there. So again, cautiously optimistic that with some new tax laws and some depreciation that we might see come into the market, that you'll see more people starting to buy. But interest rates are the big driver for sales. That is it. And we just want to thank you for joining our 2025 January New Year webinar. If you have any questions, we'd be happy to take them. You could also reach out to Kim and I if you had any questions, or if you want some additional data or analysis on your property, or you need a market rent letter. You're just trying to understand where the market would be. That's what we do. We optimize rents. We know where the market is, and we've got a lot of data to support it. Kim, we had a few announcements. Do you want to take us through that for our landmark clients?
Yeah, I sure will. And I did just put in the chat my email again for anybody that's looking for that. Our announcements is we've got 1099s going out. Those will be going out the last week of January. Year-end statements, we're preparing those right now. So all of those will be headed your way very soon. And then for those of you that have units that are geared towards the Western students, we are going to actually start our pre-leasing next week, believe it or not. And what I mean by that, we've already been preparing for pre-leasing and getting our market rents and renewal rates entered and getting letters prepared. But first letters will be going out to tenants here next Wednesday. They'll have a deadline of mid-February to tell us if they're going to be renewing or vacating at the end of their lease term. And then we're going to start the big process of leasing up all of our college rentals. So starting now, we like to be pretty much fully leased up by the time we hit July. So we are going to start that process. So again, questions, comments, feel free to reach out to me. My email is kim@visitlandmark.com. I've got that in the chat. I'll put Troy's in as well, just Troy@Moliot. I didn't see any questions, so I guess that does it for us today. But again, don't hesitate or be shy reaching out. We're here to help and happy to do so.
Awesome. Thanks so much, Kim. Appreciate you and all that you guys do at Landmark. And if you have any questions, there will be a recording. We will post this out. So for those of you that want to watch it again, you'll get a copy of that. And we're here as a resource for you. And thanks for allowing us to serve you and provide you with our market update for 2025. So with that, we will conclude and wish you the best 2025. Thank you very much and take care.
Yeah, thanks.